I'd like to now hand it over to Barry Fenton, who's the President and CEO of Lanterra Developments. Welcome, Barry.
Thank you. Welcome. I'm actually in an exciting place today. I'm in Lecce, Italy, which is kind of a fun place to be.
Wow. That's fantastic. I usually see your Andy Warhol pieces in the background, so I figured something must be up.
I picked an Italian landscape instead, but it's a pretty exciting place to be, and it really lets me kind of recharge my batteries. So thank you for having me.
Excellent. So look, I'd like to hand the mic over to you. Sal just took us over with a bit of a macro view on the market, but would love to get your outlook on the Ontario market specifically, and certainly from your perspective as one of the statesmen of the industry. So over to you.
No, thank you so much, Hesham, and I want to thank Michael Begg and his team and the whole BMO group for continuing to support Lanterra and to continue to believe in the market. I didn't come here with any notes or anything else written on a pad of paper, so I usually just tell you the way it is. And I think Sal's information prior to mine was very interesting. I'm on the front lines. I'm partners with Mark Mandelbaum at Lanterra Developments, and we've been doing this gig for many years, so it's not our first rodeo. We have now delivered to the community at large in Toronto approximately 21,000 condo units. We also have a portfolio of office buildings and retail and commercial. So we've been around. And the truth of it is, the market doesn't always go up, but we are very, very fond of the condominium business. We know that there's a lot of people watching today that want to own real estate, and in fact, approximately 70% of people in Canada are proud owners of real estate right now, so they get it. I appreciate Sal's comments, and he is a technical guy, and he's a very smart economist, by the way, one of the best in the industry. And he's going to tell you the way it is, and he bases it on baseline information. I actually believe that the market is still very robust, has a lot of latitude to go. And for example, in the last 4 years, the condominium market per se has appreciated approximately 40%. We in Canada are the number one country for appreciation in the last year. In fact, we've gone up from last year at this time 27% in house appreciation. I think we were first, and Beijing is in second place. The market in general, with interest rates low and with a lot of demand, and in our industry, especially the condominium business, there's a lack of supply right now. It only keeps the market grounded, and there's a great base to it. My own assessment of the market in general is that I think 4 years from now, if BMO would like me to come back and chat it up, I think that the market per square foot will be substantially higher. And I think there's many reasons for it. I mean, two main reasons would be the fact that interest rates continue to be low. And I think that even if we have an increase in interest rates over the next 2 to 3 years, I think that it will soften and that we will not see large increases. Second of all, there really is a demand for wanting to own real estate. Again, as I suggested a few minutes ago, there's a very, very big demand for ownership and proud to be owners of real estate. And third of all, in our business, which is mainly the condominium business, we at Lanterra, we're very proud to be instrumental in assisting the City of Toronto with some of the other large developers in creating this really large mass of wanting to recreate the thread of ownership in downtown Toronto. So, between infrastructure and between explaining to people that you can live in something like 800 square feet and have a fantastic experience, we've been able to convince people of that concept, and people are buying in. The other thing is that I always kind of look at the rental market. And I must tell you that when COVID appeared on us, I was kind of wondering how we in the condo business were going to get the reaction. And the truth of it is, from my own experience with Mark, we were in the process of leasing out a project down at Bay and Wellesley, and it was a new apartment building that we had built, and literally leasing stopped on us. Well, I can tell you that in the last 8 weeks, out of the 75-unit apartment complex, we've leased out 95% of it now. So there's no question that when COVID appeared, we had a stall. You know, even in the condominium pricing, nothing went down, but just things froze for about 3-4 months. But now we're back to it. The market is vibrant. We have a lot of room to move up. And, you know, when you look at what creates for why people want to purchase condominiums, they need living accommodations and they want proud ownership, and there's a demand for it. You know, it's interesting. I mean, and I'll let you go because I know I could sit here and talk all day long, but the interesting thing about Lecce, which I really kind of tried to bring back to Toronto, is that when I walk around Lecce, which is probably a city that's 1,000 years old, where people congregate are in these beautiful common areas just outside of buildings. And I get it. So people are used to living here in smaller spaces, but kind of enjoying themselves and communicating with others in these great spaces attached to these buildings. So without talking about Lecce in detail, I think that the market in general has a lot of way to go. If you ask me if I was concerned about anything, I'm not, except for the fact that in the last year and a half, I've seen increases in construction costs go up about 15 to 20%. So we don't have any choice but to have to pass that on to our end purchasers. But at the end of the day, I think that there's a real economy of scale of owning real estate. I think that the Toronto marketplace is incredible. The one part of the market that I never really understood was when people started to move out to places like Hamilton, and they started to move out to places like Burlington and Orillia and other places for housing. There's no question that market really heightened up in valuations. But I think you're going to see a lot of people now gravitating back to Toronto. And I think that Toronto is really going to be the place to be. And in Canada, it's the #1 place to want to invest and be in. And when you compare it to markets like New York, where a year ago the marketplace was $3,000 a square foot, and Toronto was at something like $1,200 or $1,100 a square foot, there's so much more way to move on the upside. And what I love about our marketplace is that there's real stability. There's we haven't increased 30, 40, 50% in a year because there's a long way to fall. So I hope that we continue to grow. I can respectfully suggest that banks like BMO have always been supporters of ours in our industry. They believe in it. They're not, they're very smart bankers. So on that note, Hesham, if you want to ask me a few questions, I'd be happy to answer them. But hopefully I've given you a positive spin on where I think the market is, and I think that I'm very, very confident in the longevity and the future of this business.
Yeah, no, look, appreciate the comments, and that's great to hear. I mean, we saw the decline in terms of rental and vacancy within the actual core. And to your point, we're starting to see that come back again and again as some international students come back. People are back into the office slowly, gradually and whatnot. So you're starting to see a bit of an uptick there. What I'd like to ask you is if we focus on Toronto itself, and I know you're typically traditionally building in the core, but we've seen a ton of activity in the 905 region, some in Mississauga and Scarborough, in Vaughan. I know you yourself have ventured a little bit out into kind of the Don Mills area. So would love to get your comments on that core versus a little bit outside within the GTA.
Well, there's no question that the marketplaces in outskirts of Toronto have done well over the last year. I can tell you that when it comes to purchasing land in downtown Toronto, where, for example, when Mark and I went out and we acquired Maple Leaf Square, and basically that was all of the land between the Sky Dome and Air Canada Centre, we paid something like $20 a foot. If we had to replace that today, we'd probably be paying something like $250 a foot per buildable foot to acquire a piece of land. I can tell you that in the outskirts, we haven't seen that type of escalation. So there's no question that marketplace has done well. And in fact, truth be it known, we launched a very large project in the west end of the city at 4,000 Eglinton called Notting Hill. and it will have approximately 1,400 units. And I believe we're now about 70 or 80% sold across the board. And we're achieving probably in per square foot, 3/4 of what we would achieve in Toronto. So the market is good out in the outskirts, but certain people want to live, a little bit further away. And with the transportation system now being created where you can get LRTs and a whole bunch of other stuff that the province and city is putting together, there is a more affordable way of living in the outskirts.
Yeah, I think certainly the better infrastructure, which hopefully continues to come along with the Eglinton LRT and whatnot, I think it's kind of starting to open up more and more segments of the city. So you're spot on with that for sure. Barry, what from your perspective, next 12 months, kind of short term, 12, 18 months, what do you see from your perspective, a developer's perspective, are the biggest challenges that you may face?
Number one, construction costs. They seem to keep creeping up on me and other developers in the business. I think that the ability to acquire land is becoming a lot more tougher now, as they say. And I also think that the city has done a great job helping us get through zoning processes, but I think that is a bog down now. So I think that when someone acquires a site and they expect to be able to hit the market within a 2-year period for rezonings, I think that's not realistic anymore. So what that is going to do, by the way, is cause probably an increase in pricing, probably more so than we think, because there'll be continued demand but less supply. So those are the if I'm going to say are those concerns, those are concerns. But I always look at the other side of the rainbow, and the truth of it is that owning real estate, whether it's high-rise condo or low-rise, people want to have assets like that. They need to have assets like that, and they will have assets like that. So that kind of takes away from the concerns that I just mentioned a few seconds ago.
Understood. You touched a little bit on the rental market. And I know typically condo developers were just, they build the high-rise condos and look to close on the project in 3-4 years and kind of move on to the next one. We've certainly seen an uptick in purpose-built rentals within the city of Toronto in the last 18 to 24 months. Can you, and I think you're looking at a couple of projects yourself, can you tell me just the shift in mindset there?
Well, in our case, Mark and I have decided to build some apartment buildings. One is for just to have a little bit of variety in our portfolio, but as well, the numbers now are making more sense than they did in the past. Of course, when in our business, when we go out and to finance loans based on construction for condos, there's a certain equity requirement. When you're building apartment buildings, there's a separate type of equity that's required. And basically more equity is required for building rental buildings. But what we're seeing now is there's such demand on the rental side, and you're now able to achieve rental rates that actually can support building apartment buildings. So it's a business for today. I can respectfully suggest that we have a couple of very large tracts of land that we are now going to be looking at to convert from condominium building to residential apartments, and we think the model works. But again, we're only as smart as the next person, and we have to be able to make sure that when we go out and work on a project, that it has to make economic sense. But the rental complex for sure makes a lot of sense, and I actually think that the rental rates are going to continue to do very well now, right across the board, over the next 2 to 3 years.
Yeah, I was reading an article this morning showing the rebound in 1-bedroom, 2-bedroom rates back from where it was in 2019 to 2020, and we're almost back to kind of level off. So you kind of see the impact of COVID, and all of a sudden we're back within about an 18-month period. So yeah, I tend to agree with what you say for sure.
And can you take us? We have to
go ahead.
Sorry. No, we also have to appreciate the fact that Sal mentioned a very interesting point before, and that was that he suggested that there's going to be something like immigration of 300,000 or 400,000. I actually thought it was about 250,000, but that puts a lot of pressure on the rental side. And in fact, it's good pressure. I mean, it's good pressure from from a real estate developer and someone that wants to delve into real estate. But the rental marketplace is just going to be supported by the demand of people, and we are not going to have enough supply in order to deal with the demand.
Yeah.
Sorry, I didn't mean to interrupt you.
A viable option in terms of an alternative, as opposed to just being able to, purchase a condo or purchase a home. I think rental, as we see in Europe and other places around the world, that is an option that we need to offer to folks here in Canada.
That is the case for sure. But if you go back in history in this business, close to 70% of Canadians own real estate right now. And what's thrusting the market right now is half of the population, I believe, between 25 and 35 years of age want ownership of real estate now. It's probably closer to 70%. So I think that the rental market is good and it's great for certain people, but I think that overall, when you have a base of people wanting ownership of real estate, that takes, in fact, that would probably take a little bit of pressure off the rental market.
I want to switch gears because I know you are active on the U.S. side, and so just 1-2 minutes, just your view on the U.S. market and where you're active there and what you're seeing.
No, thank you very much. So we have a very large tract of land with some other partners in New Jersey, in an area called Journal Square, and it's just right across the waterways from the World Trade Center area. And it's about 500,000 square feet, and we're building rental buildings there. And about a year ago, about a year and a half ago, what was happening in New York was that people were moving outside of New York for tax purposes, and they, as well, the rental markets in New York were just screaming high. So a lot of people now are moving outside into New Jersey, and we've found a really, really creative opportunity with some others to build product. The interesting thing about that market right now is that when COVID hit, to be quite frank, the lending market shut down, and it kind of reminds me a lot of what happened in 2008 when there was a liquidity crunch in Canada where you couldn't borrow a dollar even if you were doing everything right. And that was probably, for me, the most scariest part of my career over the last 60 years. But the market in certain parts of the States, no question, dampened. For example, in Miami and in New York. But those markets have come back substantially. And like, as I suggested at the beginning of my speaking here, what I was telling you is that I am concerned. What I like about Toronto is that there's a consistency, and there's a consistency of 10% a year increases or 8% a year of increases. But what happens in New York from a condo selling standpoint is that you can see it drop 30% and then back up 30% or 40%. So that to me is like a roller coaster, which I don't really like to go on. But from a rental market standpoint, I think the projects that we're doing in the States have a lot of wind behind the sails, and they have a lot of consistency. But overall, I think the market in the States will be very buoyant. And I think you can see now what's happening, because I read a lot of the reports, and the U.S. market has literally turned around 360 from hitting a low, and it's probably at a higher level now than it was a year and a half ago. So hopefully, Hesham, I've answered your question, but maybe not, because I like to wander when I speak.
Yeah, no, you absolutely have. It's always just fascinating for us, and especially with our North American platform at BMO, we see really kind of both markets and get an idea of there are very greater swings within the U.S. market versus what we deal with in Canada. So fundamentally, very, very kind of different markets, and just great to kind of hear what your thought of it is. So,
but just to leave you on this note, Hesham,
sure.
Sorry, just to leave you on this note, and I know we're going to do some other stuff now, but really from the viewer standpoint, and I'm not selling stuff here. We are very much a believer in this market. We very much are appreciative of what you at Bank of Montreal have done for us, because you really need to have strong financial partners, no question about it. And I think that for the viewers on the other side of the screen, you have to appreciate the fact that 5 years, 6 years, 7 years from now, I think we're going to be looking at substantial increases in certain markets. And I think our condominium business will be great. I think the low rise will be great. And I think that when you compare Canada to other parts of the world, I think that that we've seen nothing yet. And we are so much stronger than is sometimes presented about where people want to live. So as I would tell everybody, look out and let's go forward.
Hey, great outlook. Great outlook. I love the positivity, and I think it aligns with Sal's comments earlier as well. And maybe we can pull in Sal and Mike for we're going to do a bit of a roundtable, a bit of a Q&A. Sal, I'll start with you, and just wanted to ask you, with the federal election obviously around the corner, I know you touched on it earlier within your presentation, but do you see any particular party or any particular policy that will really address the affordability and the supply of housing within Canada?
Well, Hesham, I don't see anything on with respect to the demand policies that are going to improve affordability. If anything, they're just going to, in some way, stoke demand, and that's going to end up in higher prices. But it's some of the supply side measures to encourage construction of lower end units, repairing of lower of buildings as well, I think are beneficial. The problem is they're going to take time to eventually show up and increase supply and an improvement in affordability. I think the best thing the governments could do at all levels is just remove the shackles from builders, reduce restrictions, whether it's zoning or any other constraint, and also try to reduce fees and costs for builders, taxes, for example, because that's the only way. If the private sector, the builders themselves, can really crank up production, supply, will we see a notable improvement in affordability in this province, outside of prices actually correcting lower.
Yeah, appreciate that answer, Sal. Mike, anything you may want to add to that, just with regards to affordability and supply?
Yeah, well, you know what? I joined the local home building association on the board for Build here in Toronto, and I did that not to make connections. We know everyone and they know us, but it was really to take a stronger vocal view on supply. And from my point of view, we just need to think in terms of adding a story or two to transit corridors and nodes, no matter where they are. And we need an approval process for Barry's and our industry's projects that, instead of 5 or 7 years, can get something approved in 2 to 3 years. That seems to be the consensus time period when I talk to clients, would be a more rational approach. So that requires some reverse engineering, and it requires some partnership at federal, provincial, and city levels to make that happen. So I think that, we by design have an accommodative monetary policy, and we need it, because we're coming out of a pandemic and a recession. And by design, we have an immigration policy that I think all three political parties support. So Canadians support these things, and these are our values. So we need to match up the supply side with it. And it maybe sounds repetitive and whatnot, but I'm looking at 30 questions in the chat, and unfortunately we can't get to them all, but most of them are on this supply topic. And someone asked a question about the rural markets. Okay, not to be Toronto or downtown centric. Are those sustainable trends? Yes, as a general rule of thumb, when you have 30, 40, 50% year-over-year price increases anywhere, whether it's downtown or in a 1 to 2 hour drive of a place like Toronto or Vancouver, you have a higher likelihood of a correction. On the other hand, the demand factors are strong, the supply factors are tight. So I'd point back to the last time we saw that happen in Toronto and Vancouver, more of an urban surge in price levels. And we had like a 10 or 15% lull in prices for about 18 months, and then it was back to normal. That is the future reality. We're going to have these periodic kind of bubble periods that will not be severe because the supply is tight and demand is strong. And the only way to fix that is to come up with a better supply model. And so maybe I'll leave it there with your question on supply.
Sure. And thank you both for that. Go ahead, Barry.
No, so Mike, I just want to say you're spot on. But, the interesting thing is that when the party goes, people seem to think there's a problem. There really isn't a problem here. And I think that in life, sometimes things don't go straight up. But when you have a great base, and real estate to me is a great base, and I think that we're going to come back 7 years from now or 6 years from now, and the market's going to be substantially higher. So perfect example is in 2009, and maybe Sal, you can tell me if I'm incorrect, but in 2009, the average selling price of a house was something like $379,000. Today, 2021, September the 14th-ish, and I'm in Lecce, so we're only 6 hours ahead. The average price of a house is over $1 million. So, and we have had a few headwinds, right? We've had COVID. We've had a few other issues go down in the last 10 years. We've had some political stuff going on in the States. But when you have a good asset and you have something that people need to have, want to have, and should have, real estate's a good game. And again, Mike, you're right. I mean, there is an issue with supply and demand. Listen, let's be frank. If Sal and the other economists decide to convince people that we should go from prime being 3.25% in Canada to 8 or 9%, we're going to have a problem. There's no question about it. But I don't see that happening for the next 20 years, 30 years. So I think we're all good. And the only other thing I wanted to mention to you was that I think that we have a lot more interest in Canada now for the market because of the way the currency works. And, we're not dollar for dollar. We're $1.30 or $1.28. When you're in Europe, you're $1.50. So I think that attracts a lot of substance to our Canadian marketplace as well.
So I could offer something very quick on that point too, to build off of Barry's, because there was a question in the chat about how do you increase supply? And I talked about federal, provincial, and city level, but I do think it's not only density along the corridors, but different options for density and product types. So we're seeing creative uses that can be brought to bear with modular home construction, with carriage home construction that doubles maybe the amount of occupancy you can have on an existing residential lot. There's laneway access. I'm seeing this in downtown Toronto where you have the century old homes that have a garage in the back, and you can build a couple units above the garage and still keep the garage. Whether this all works from a traffic point of view, I think it certainly can be helped to work from a traffic point of view. We're moving to more sustainable forms, I think, of transportation in the future. That don't require everyone to own a vehicle, and a lot more bike riding and whatnot. So I think there's many options here for increasing density and more sustainable and climate friendly, frankly, green friendly products. There's a win-win there on both fronts in terms of finding more affordable options. So I'll just throw that out because that was one of the questions in the chat.
So look, I wanted to touch on something else as well, just given, and Sal, you mentioned it, just with regards to supply chain disruptions. So Barry, how are you dealing with some of that, with a lot of supply coming online? And then on top of that, we always hear from our clients, just as far as the trades are concerned and labor and some of the issues there. Just curious on your take and how are you counteracting that?
Well, I'm not really sure, and Hesham, just help me out here. You're suggesting that we have too much supply coming out now, and that's going to cause a problem
because of all the new towers coming online and all the development. There's a real shortage as far as labor and trades, and we hear that often. It seems to be like a real issue in Canada if we think about it on a long-term perspective. So just curious how you guys at Lanterra are thinking of that.
Well, it's interesting because I'm on the front lines, and I can respectfully suggest, and just my own information, because I'm on the front line, as I suggested. I think that we have less supply coming out now than we did 2 years ago and 3 years ago. So I happen not to 100% agree that there is so much of an issue with labor. There's no question that there is. We have an issue with some labor. We have an issue with some commodity pricing. But I think, and I don't want to say this in a bad way, but I think a lot of this sometimes is created by the trades themselves. So I'm hoping that things settle down. But I think that if we need to build a building, we'll build a building. If we need to get supplies, we'll get supplies. And I just think that there's a lot of great trades that we use and a lot of great opportunities for people to figure out ways to build things. So I'm not concerned at all about supply. I would have been 2 years ago, to be honest. But I think that as things trail out and come out, we'll have no problems building them. My bigger concern has always been trying to get the product to the community as fast as we can, because that is a problem. And a lot of it is because of the red tape, in the government areas. So just to summarize, I think that the supply issue will never really be an issue, because we'll always have the ability to figure out a way to build stuff.
Great. No, that's good to hear. And hopefully it's not a long-term issue. I just know that we need more people entering that part of the supply and the labor force, if you will. So, Sal, just one for you. Go ahead.
Hesham, sorry, if I could just weigh in on that. Actually, when you hear all these stories of labor supply shortages, that's really not in construction so much, and some other industries that were not impacted very much by the pandemic. It's really in some of the hard hit industries, so restaurants, hotels, and that. And a lot of the lower paying industries, where workers are just fearful of going back, returning to their former jobs because of health concerns, and they're kind of moving into industries that pay more and expose them less to the pandemic, the virus. So I mean, that's where we're seeing the labor shortages, both in Canada and the U.S., as kind of some of these other industries hit harder by the pandemic.
And Sal, if I may just comment from my own experience, Mark and I at Lanterra are partners with Maple Leaf Sports and Cadillac Fairview in the Maple Leaf Square project downtown, and part of that complex has a hotel. And I can respectively tell you that over the last 6 months, one of the biggest issues for us has been trying to find staff in order to, we don't manage the project, Le Germain does, but they at Le Germain have had problems managing they're having troubles finding staff to come back to work. So I think, Sal, your point is right on. And I think that the issue of labor is not so much from construction. People just think that when you hear a comment that labor has an issue, that everyone relates it to everything. But I think that you are correct, that the hotel industry and restaurant industry is tough to locate people now to work in.
I should probably interject very quickly and just say the focus of today has been weighted to the builder segment and housing, mainly because we do a separate income property outlook, but our non-residential and residential income property book trends have fully recovered across the banks really over the last half of last year, and so very stable. But to Sal's point and to what Barry just said, there is that sliver. I think Sal's team estimated at around 4 or 5% of GDP that can't recover until social distancing is gone. And social distancing is definitely not completely gone yet. And so those segments are still hurting. But I think the expectation is relatively stable trends. So retail has a generally positive outlook subject to that. And office, probably a 10 or 20% demand adjustment, I think, over a couple of years, but it'll find a new reestablished base, and it'll pick up from there, very much tied to economic growth. So, on the non-residential and income property finance side, we have a generally stable outlook, subject to those comments that Barry and Sal touched on.
And that's spot on, Michael. You're so accurate about that comment. And in fact, on the office component as well, I think what I'm hearing from pension funds and others who own the office component is that there's going to be probably more demand for having to pay more because of the spacing issues and stuff. So I think that you are right, Michael, that the market on the other side of the equation, which is the commercial and retail and industrial stuff, has really just is going to pick up pace again for sure.
Excellent. Well, on behalf of BMO, as we're near top of the hour, I want to thank everyone for joining us this morning. We hope you enjoyed this morning's session. We really appreciate you taking time out of your day to join us. So thank you very much for that. I do want to thank our guests, Sal and Barry. for giving us their views on the market, macro and micro. These guys always say it like it is, and we really appreciate it. And I'm always taking notes, getting a little smarter as I listen to these folks. As a reminder, today's call will be recorded and there will be a playback. So you should receive an email later this week with some playback details. And this is it for us. So thank you very much. Take care and be safe.